All right, welcome to The Explainer. Today, we're diving into a world that moves billions of dollars, but often speaks in a language of its own. We're going to demystify the essential vocabulary of private equity so you can really understand how these massive deals actually get done.
So, what is this secret language we're talking about? Well, it's the lingo used in boardrooms and pitch decks to structure deals, manage funds, and, well, ultimately make a lot of money. It might sound kind of intimidating, but trust me, it's really just a set of rules and roles. In this explainer, we're going to translate that complex language into plain, simple insights. By the end, you won't just know a bunch of definitions, you'll have a real, solid understanding of how this industry works from the inside out. So, let's get into it.
First things first, you gotta know who's who. I mean, the entire private equity universe really revolves around two main types of players, plus a key qualification that separates regular investors from the ones who can get in on these deals. So on one side, you have the general partner, or the GP. Think of them as the fund's brain, right? They're the active decision makers who find the deals and run the whole show. On the other side, you've got the limited partners, or LPs. They're the capital providers, the investors. Their role is passive, and this is crucial. Their financial risk is limited to however much they invest. This simple structure, it's the foundation of the entire private equity model. Now here's the thing, not just anyone can be an LP. To protect people from the really high risks of these private markets, regulators like the SEC created a special designation. It's called an accredited investor. You can think of it like a gatekeeper, making sure investors have the financial cushion and know-how to handle potential losses. So how do you actually qualify? For an individual, it really boils down to a few key financial tests. You either need a net worth over $1 million, and that doesn't include your main home, or you need a steady income of over $200,000 a year, or $300,000 with your spouse for the last couple of years. You can also get in with certain professional licenses. So remember Jane, the tech entrepreneur from our source material? With her net worth of $2.5 million, she easily qualifies and can legally get into these private funds. All right, so we've got our players, the GPs and the LPs. So what's next? Well, now it's time to actually get the money into the fund. And this isn't like just depositing cash into a bank account. It's a very structured, multi-step process. It all kicks off with something called a commitment. This is where an LP signs a legal agreement, basically pledging a specific amount of money to the fund, let's say $10 million. But here's the catch. They don't wire all that money at once. When the GP finds a good investment, they'll make a capital call, asking for just a piece of that pledge. Once the LP sends the money over, that part becomes funded capital. So the total commitment is always split between what's been paid in and what's still waiting on the sidelines.
This chart here shows it perfectly. Let's stick with that $10 million commitment. If the GP has called for $6 million so far, that's the funded capital. The other, $4 million? That's the unfunded capital. You'll often hear this called dry powder. It's the firepower the GP has ready to go for the next big deal. And knowing the difference is absolutely critical for managing the fund's cash and investment rhythm.
Okay, so once that capital starts flowing in, the GP has a job to do. I mean, they have to manage it, right? That means finding deals, doing all the due diligence, and paying for all the fund's operating costs, salaries, rent, the works. And that is where fees come into the picture. The main way a GP covers all those operational costs is through the management fee. It's usually about 1% to 2% of the total committed capital, and it's charged every year. Now, this isn't the GP's main source of profit, not by a long shot. It's really the operational budget that, keeps the lights on and lets the team focus on what really matters, finding and managing great investments. And now, for the most exciting part. What happens when an investment actually pays off and it's time to hand out the profits? This is where a super important concept called the distribution waterfall comes into play. It's basically the rule book for pay debt. The waterfall is a tiered system that spells out exactly who gets paid, when they get paid, and how much they get. The whole thing is designed to make sure the GPs and the LPs' interests are perfectly aligned. It ensures that the investors get their money back, plus a decent return before the manager starts taking a big piece of the profits. So let's break down how this works. A typical waterfall has 4 tiers, and the order is everything. It's what keeps everyone on the same page. First up, return of capital. 100% of any money coming out goes straight to the LPs until they get every single penny of their initial investment back. Next, the preferred return. The LPs get a minimum profit, often around 8%, which is a hurdle the GP has to clear. Only after that can the GP get to the catch-up phase. And finally, you get to the final split, where the rest of the profits are divided up. usually 80% for the LPs and 20% for the GP. To make this crystal clear, let's just walk through a quick example. Imagine a fund puts $10 million into a company. A few years go by and they sell it for $13 million. Simple math, right? That leaves us with a total profit of $3 million. And this $3 million is the money that's going to flow through that distribution waterfall. But hold on. Before anyone even thinks about profit, the first $10 million of that $13 million total goes straight back to the LPs. That's step one, return of capital. Done. Now we're left to figure out what happens with that $3 million profit. And this brings us to the ultimate prize for the general partner, carried interest, or just carry. This is the GP's cut of the profits. It's their number one incentive to generate huge returns. A 20% carry is pretty much the industry standard, which is why you'll often hear people talk about the 2 and 20 model. That's a 2% management fee and a 20% carry. So, let's assume the preferred return and catch-up steps have been handled. That $3 million profit gets split 80-20. The limited partners get 80%, which is $2.4 million, and the general partner gets their 20% carried interest, which comes out to $600,000. This chart right here, that's the final payday for everyone. But wait, there's a really key protection for the LPs called the high water mark. What this does is it makes sure that if the fund's value ever drops, the GP can't earn any more performance fees until the value climbs past its previous peak. This is huge. It stops investors from paying performance fees on the same gains twice and makes sure the GP is only rewarded for creating new value. Okay, so we've covered the players, how the capital works, the fees, and the payday. But why does all this lingo actually matter so much? Because, look, understanding these terms isn't just for a test. It's the key that unlocks the door. Whether you're trying to nail a job interview, you're already working in the industry, or you just want to be a smarter investor, this vocabulary is foundational. It's the language of competence, the language of confidence in this really complex but fascinating world. So now you've got the building blocks of the private equity language. You know the difference between a GP and an LP, you know how capital is called, and you know how everyone gets paid through the waterfall. So, I guess the only question left is, what doors will this knowledge open for you?